Welcome to the ETF Atlas podcast, the show where we explore the world of investing and ETFs with leading voices in finance. I'm your host, Jack Lampard, and today we're thrilled to be joined by Rick Ferri, a titan of low-cost investing. Before we dive in, however, I'd like to spotlight ETFatlas.com, your new comprehensive gateway to the world of ETFs. Our platform offers an extensive database covering ETFs domiciled in the United States, Europe, and Canada. Whether you're building a portfolio, comparing funds, or maybe researching market trends, ETFatlas.com provides a powerful tools to analyze and discover ETFs that match your investment goals. And now let's start discussion with our guest, Rick. Thank you for joining us today. And I think that many of our listeners may know you as a financial expert, but actually your journey is quite unique, I would say, because you had, another in the past profession. And could you start by telling us about your background and how you transitioned from being a Marine Corps fighter pilot to a renowned figure in the investment world?
Well, I went to college for finance. I graduated in 1980. And after college, I went into the Marine Corps as an officer and had the opportunity to go to flight school. Marine Corps sends pilots to Navy flight school. So after about a year's worth of training in the Marine Corps, I went down to Navy flight school, and over a period of about a year and a half, I achieved my wings and became a fighter pilot, and did that for about 8 years total, and then stayed in the reserves for another 13 years. So I ended up retiring from the Marine Corps. However, after 8 years of active duty, around the end of 1988, I decided I was going to go back to what I went to college for, and decided to go to Wall Street and learn how to analyze companies and invest other people's money. So I was hired by a Wall Street firm, and that was the beginning of my journey toward learning how to invest, learning about the markets and learning how to invest.
All right. That's very interesting. And we will dive into details in a minute, but I wanted to ask you a question about discipline, because you emphasize that philosophy, strategy, and discipline is, let's say, a foundation of investing. However, how these components interact and why discipline often is maybe even the hardest part to maintain?
Well, I think discipline is the hardest part. It really separates successful investors from people who are not as successful. Now, the markets, just being in the markets makes everyone successful for the most part, unless you're taking excessive risk and you lose. But I mean, just being in the markets, you do get a little bit of the ride. But in order to just get a good return, the return of the markets, you have to be very disciplined in how you do it. You need a philosophy of how you're going to approach investing. You need a strategy that suits your particular needs, which would be taxes. It would be your ability to take risk, or your need to take risk, what you have available to you. So the strategy is built upon the philosophy of how you are going to approach the markets. And then once you have all of this, you have to implement it and you have to maintain it. And that's the hardest part, is the discipline, because there is so much noise out there. People pulling you all different directions to do all different types of things. And if you don't maintain what you believe, you get pulled off course. It's just going to be a much bumpier and longer ride before you reach financial security.
Okay, you mentioned about investing in the whole market, and I wanted to ask you a question. Is index investing synonymous with passive investing, or maybe there are some nuances? Because maybe it's, at least I see that quite often when there are some discussions about this, that it's not that easy to draw the line between passive and active strategies. What's your definition here?
Well, originally, back when the first index funds were created, they were following market indices. The classic one is the S&P 500, which is 85% of the US market by capitalization. Basically, you could say 500 of the largest stocks in the US. The first index fund created back in 1976 by Vanguard, the first publicly available index fund, followed the S&P 500. It was a well-known benchmark of mostly large-cap U.S. stocks. The first exchange-traded fund in the U.S. that was created, I believe it was 1994, SPY, Spider, was tracking the S&P 500, basically an index, again, of large-cap U.S. stocks. So the original index fund was tracking markets. They brought into the total stock market. They were total international market, a total bond market, originally the Lehman Brothers, and now it's the Bloomberg total bond market. So originally indexing was following broad market benchmarks that tried to give us what a market is doing in aggregate and capitalization weighted. So that was the original intent of indexing. However, it was sidetracked in the early 2000s because a fund company came along and created a quantitative way of managing money and how to select stocks, how to weight stocks, very, very different than a capitalization weighted index. But they called it an index. And this was Power Shares back around 2004. And the Security and Exchange Commission allowed Power Shares to call their very heavily quantitative, actively managed strategy an index because it published on a daily basis what was in the index. And then this was then turned into an ETF. Well, now that all changed everything, right? So all of a sudden, the idea of an index being a market was diluted heavily. And we had all of these different types of indexes coming along. Basically, anything could be an index as long as there was a methodology for selecting stocks and weighting stocks and creating a list that was transparent and then turned it into an ETF. So now anything can be an index. And that's where we came along a few years later with fundamental indexing and strategic indexing and all these other different things that were called indexes, but were actually active management disguising as indexing because of the popularity of passive indexing. So they wanted to market themselves as an index when in fact they really weren't, but the SEC has still allowed them to do that. So it's been diluted. So you really have to divide the world up between traditional benchmark indices, which are cap weighted and all inclusive, or try to be all inclusive, and then everything else. And my focus has always been on the traditional indexing because it's the very low cost, widely diversified strategies that allow you to, I think, capture market returns, which that alone, if it's in a portfolio of different asset classes, outperforms 99% of all this other stuff over here that's being called indexing for marketing purposes.
And by the way, do you maybe have any preference between S&P 500 and global stock market? Do you have any preferences here?
Well, the S&P 500, as I said, was the first index fund and the first ETF, but I prefer to use total market indices. So the S&P 500 is 500 companies, but why not buy all the companies? Later on, the S&P 500 was the first one, but then it expanded so you could buy a total US stock market index fund and a total international stock market index fund, which includes developed markets and emerging markets. And you could also now buy a global market index fund, which includes over 10,000 stocks from US and internationally. So do I have a preference? Yes, I'm a global investor. All I'm trying to do is capture the global growth of markets around the world, global GDP, if you will, global trade, call it whatever you will. But in the end, I'm just trying to capture the global growth of the economy through U.S. and international index fund. Now, there's some tax reasons why you may not want to use a global index in a index fund in a taxable account. You would want to split it between U.S. and international, but it has to do with taxes rather than the concept.
I understand. And what if everyone adopted passive investing, this index investing? Would markets still function efficiently? I know this question is appearing very often, but could this create some unintended consequences? And I hear again and again this, information that now we went too far and maybe it will have, there will be no happy end because everyone will start index investing.
Well, it's actually impossible to happen. It can't happen because the companies are buying their own stock back to do RSUs, and it's in theory, it's not even possible in theory because of the way companies issue stock and buy back their stock. That it's not going to be that way. So we've heard this probably easily 25 years now as indexing has become so popular that what if everybody indexes? Okay, that's a hypothetical that isn't possible. You couldn't even put a probability on it because it's not even possible for that to happen. So I don't know what the answer to that is. If there's not even a probability of it happening or a possibility of it happening, I should say. So, and it's not plausible that it will happen because there's always going to be people who are going to try to outperform the market. So there's always active management going on. And just these ETFs, as I was talking about, these index funds that are created that aren't index funds, they're actively managed funds that are being called indexes. I mean, they're trading stocks, so it's not going to happen. It can't happen, and so I don't know what would happen because it's not possible to happen.
Yeah, sure, of course. By the way, I saw prediction by Morningstar that this year it will be the very first time when we have more active ETFs than these truly passive ETFs, which is also partially some answer that not everyone will be passive.
Well, one of the reasons for that is because Vanguard came off patent on their ability to link a ETF to a mutual fund. So Vanguard had a patent for many, many years back when they developed what we call Vipers, which they did away with the Viper name and they just became Vanguard ETFs. But back in the early 2000s, Vanguard had a patent on issuing a mutual fund that had an ETF share class. So the ETF was a share class of a mutual fund. And they had a patent on that. It went off patent a couple of years ago. So no other company could issue, Putnam couldn't issue ETFs or Fidelity couldn't issue ETFs on their traditional mutual funds. Well, Vanguard's patent went off patent a couple of years ago. And so now a lot of companies who already have mutual funds out there, traditional mutual funds, are now issuing an ETF share class of that mutual fund. So that's what a lot of this active management ETFs coming out are. It's just a different structure, a different distribution mechanism now. Don't confuse ETF with index funds. ETF and mutual funds are synonymous, but not ETFs and indexing. You don't have to follow an index to have an ETF, just like you don't have to follow an index to have a mutual fund. An ETF is just a mechanism for delivering a product. And just like a mutual fund, traditional mutual fund is under a different set of rules, but just the way in which a pipeline by which a portfolio is delivered. So just want to make sure that ETF and indexing are not the same thing. One is a delivery mechanism, the other is an investment strategy.
Okay, I understand. Rick, you have often emphasized that bonds are the primary tool for reducing the portfolio volatility. Yet you have also critiqued active stock picking or active approach as a, in fact, zero-sum game where most investors underperform. But there is something called managed futures, and particularly the trend following ETFs, which are implemented through the managed futures. And now they offer exposure to, let's say, to a entirely different approach, which is uncorrelated to stocks and bonds. And given the historical negative correlation to equities and potential to reduce volatility without sacrificing returns, what we have with bonds, how do you view these strategies?
Well, managed futures have been around for many, many decades. Now they're in a exchange traded fund format. Back in the 1990s, I believed the same thing that you just said, that, oh, managed futures are non-correlated with stocks, and therefore, if you added them to a portfolio, you could get a portfolio effect where it would reduce the volatility and therefore compound your return at a higher rate. And all of that, I believed it all. Hook, line, and sinker. I bought it all back in the early 1990s, and so I used managed futures in my clients' accounts. It was a disaster. It didn't happen that way, and it still's not happening that way. It sounds good, sounds great. It just doesn't work good. It never has. And I doubt just because now they've taken this and put it into an ETF form, it's going to work. There are times when managed futures, which again, are managed, meaning actively managed, they're trading futures contracts on all kinds of commodities and all different types of futures. Trading futures contracts is a long time honored thing. Speculators, they're buyers and sellers of these futures contracts. But in the end, the fees eat up, if there is any alpha at all, the fees eat up the returns. They just don't do what you would think they are advertised to do, and never did. And then there's a problem of picking the right managed futures approach. They're all over the map as far as the rate of return because these things are actively managed funds, so they're all over the map. Even the futures indexes, commodities indexes, how they're developed, the returns are all over the map because of different ways of weighting various commodities and such. I mean, it's just not, you can't put your finger on what is the return of managed futures. You can put them all together and say, okay, well, the average return is this, but the dispersion of return is so wide that you got to be really lucky to get a winner out of that group. So it's, you're betting on active management. You're taking money away from known earnings growth companies. Stocks grow because revenue grows, because GDP grows, earnings grow. That's a known phenomena. That as long as we have trade, as long as we have companies, we're going to have growth. It's a known thing. That's what happens in the stock market. So eventually stocks will grow. Bonds will pay interest. You're buying bonds, they'll pay interest. You're going to get cash flow from interest. What do you get from commodities? If you just bought a commodity future and did nothing, your rate of return is zero because it's a zero-sum game in the long term. Just putting them in a managed fund, meaning there's got to be winners and there's got to be losers and there's always fees. So you're taking away from known growth of equity and known income from bonds to invest in something that's speculative, all based on the idea that it's non-correlated with stocks and bonds. Therefore, it's going to give you a different return path. Therefore, when you mix them in with stocks and bonds, the volatility of the portfolio is going to be less. Therefore, it's going to compound out at a higher rate of return. It all sounds very good. It just hasn't worked. And I doubt seriously it's going to work going forward. But, if people want to, people on Wall Street have to live. So they have to come up with these products. They have, they have to get fees. And this is one of the ways of doing it. I don't need to participate in that. I don't need to participate in everything that Wall Street comes up with. Okay. I need to get the returns of the bond market. I need to get returns of the global stock market. If I do that over my lifetime, I'm going to be further ahead than 98% of all the people who are doing all this other stuff. That I do know as a fact.
All right. And do you believe then individual investor can ever successfully pursue active strategies, or is indexing the only rational choice for long-term success?
Well, if you're looking at the probability of success, then just a portfolio of a few simple total market index funds has the highest probability. Sure, there's going to be people who outperform. They picked Apple at $5 a share. They picked Nvidia at $1 a share. Yeah, they're going to outperform. There are very few that do outperform. And is that what you should be trying to do with your retirement money that you're going to need to live on later on down the road in retirement, or the money that you want to use to send your son or daughter to college? And the answer is no. The logical thing to do, given the data, given the evidence, long evidence now, is to just put your money in a few index funds and based on what you need and rebalance occasionally, be tax efficient, be as low cost as you can. That is the highest probability of you getting to financial success. All the other stuff, you might get there, but the probability is very low of you getting to the same level as you would get at if you just had a few good index funds.
But even these, let's call them lazy portfolios, they require discipline. How can investors avoid tinkering with their strategy during especially higher market volatility?
Well, it's interesting that a lot of 401k plans, 403b plans, 457 plans, 529 plans have very low cost balanced portfolios that you could buy, indexed portfolios, like a target retirement index fund, not just any target retirement fund, but a target retirement index fund. Vanguard has these, Fidelity has these, State Street has these. They're a very, very low cost index fund of funds. So you might cost you 0.08%. And the fund does everything. It has the US stock index in there, the international stock index in there, the bond index in there. So all you need to do in your 401k is decide which year fund you want to invest in based upon what the asset allocation is of that fund. So if you want to have, say, 80% in equity, you might buy a 2035 fund. If you want to have 90% in equity, you might buy a 2050 fund. And it'll be, they'll do it for you. You don't have to do anything. If you do that, the probability of you staying the course is actually quite a bit higher because it's automated. You're not touching it. You're not managing it. It's being managed by Vanguard, or it's being managed by Fidelity or State Street in a very low cost fund. Now, in a taxable account, it's a little bit different. What keeps you a little bit disciplined in a taxable account, because taxes are involved, is the fact that if you bought stock index funds in your taxable portfolio and they go up in value, people don't like to sell because they have to pay taxes. So believe it or not, taxes keep people in the market in a taxable account. So they won't panic sell, because if they do, they're going to get hit with all these taxes. And of course, that's no fun paying taxes. So that has some bearing on it. But the best thing to do is just say, I have a plan, I have a philosophy, I have a plan, I have an overall asset allocation of what I want to maintain, and not messing with it and just looking at it once a year, making changes once a year to get it back to your asset allocation. It's very difficult to not tinker with it, very difficult to stay the course. But if you can, you're going to be better off in the very long term.
You've said once, Rick, that simplicity is the ultimate nirvana of indexing. How do advisors then can help clients resist this allure of complexity?
Well, a lot of advisors are the cause of the complexity. I mean, I look at client accounts daily, and they're being managed by advisors, and the advisors just make the portfolio complex for the sake of job security. So you look at these portfolios, especially taxable accounts. It's really frustrating to look at taxable accounts and see 25 different ETFs in a taxable account. That is just absurd. It's an absurd way to manage a taxable account. You're guaranteed to underperform because they're trading these things. It's just a mess. But the reason why the advisors do it is because it's job security. If the clients don't really understand what's going on, they don't want to mess with it, and they'll continue to pay the advisor. It's a shame, but that's the way the business is. And some of the biggest firms on Wall Street do this to their clients. If you have a very simple portfolio, you're only going to be using a few good funds, just a few. Like I said, in the 401k, you might use a target date fund. In your taxable account, you might use a US total stock market fund. And depending on your income, you might use treasury bonds, or you might use a municipal bond fund. In your Roth account, you might decide to use an international fund because it pays high dividends. I mean, there's just a few funds that you need. This is a problem for advisors because advisors need to show a client that they have a lot of funds in their portfolio. I mean, they're running some strategy, some model, okay? And that's not in the best interest of the clients, but it's in the best interest of the advisor. So if advisors would stop trying to make things complicated for clients for the sake of job security, if instead they actually advise the clients on what is in their best interest, we'd see the number of securities in these accounts start to finally come down to something that's reasonable, manageable, and that the client can understand. And if advisors were advisors rather than trying to be portfolio managers, trying to do some strategy that's going to outperform or whatever it is they're trying to do, retain asset management fees, I think we would all be a lot better off.
All right. Rick, in your podcast with the White Coat Investor, you were an outspoken critic of assets under management fees. And since then, you've pioneered an hourly consulting model for financial advice. And I wanted to ask you, how has this shift impacted your perspective on client relationship and the value of financial advice? Have you maybe observed any changes in how clients approach the investment when they are paying for time rather than a percentage of assets?
Well, first off, I'm not opposed to a percentage of assets if you're an advisor and you're going to manage clients' portfolios because the client wants you to manage their portfolio, or maybe in the case of a trust relationship or a nonprofit organization, they need to have a money manager manage the portfolio. Fine. AUM fees is a way to get paid to manage a portfolio, but it doesn't have to be 1%. I mean, for years and years, I had a company, we managed portfolios for 0.25%. And that was 25 years ago before we had the technology that we have today. It doesn't cost very much at all to manage portfolios today. So charging 1%, the problem with AUM is charging 1%. That's a problem. It should be much, much lower than that on average. Getting back to the advice side, you get paid a fee for managing money. That's fine. That's a money management fee for managing an investment portfolio. If you're also giving the client advice, financial planning advice, tax advice, estate planning advice, insurance advice, financial advice, that should really be a separate fee. It should be based upon how much time it takes you as an advisor to advise to the client. So in my view, there should be two separate fees. Either you're an advisor and you're just doing advice, which is what I do now, or you're a money manager and you're just managing investment portfolios with just enough advice so you know how to manage that portfolio for risk and for taxes. Or if you're going to do a combination of both of those things, there should be two different fees. There should be the portfolio management fee to manage the portfolio, and there should be the hourly fee or some sort of a fixed fee for giving advice. And that's what I think a better model is. Mixing them both together and charging the client 1% doesn't make sense. You get a $1 million client who has $1 million IRA, you're charging them $10,000 a year for management and advice. And then you've got another client who's same age, only they have a $2 million IRA. And so you're charging them $20,000 for the same thing. It doesn't take you any longer to manage the $2 million account than it does the $1 million account. And you're not providing that $2 million client 2 times the amount of advice that you're giving to the $1 million. I mean, it's complete backwards model for how to charge for advice. So my view is you separate it. You have a fee for managing the client's assets, which is a very low fee based on technology today, 25 basis points. And as clients get larger, over a few million, you could be zero for that extra money because really you're not doing anything extra. And then you charge a fee for the advice that you provide. I think it's just a fairer model. It aligns the fee with the work that the advisor is doing. And that's all I'm an advocate for. Advisor fees should be aligned with the amount of work the advisor does. It shouldn't be based upon how much money the client has. But that's just, I've been on this for a long time. And I was on it when I started my company back in 1999. It was the same thing when I said, okay, I'm managing money is cheap. Should be 25 basis points or less. And that's how I started the company as a money manager. Now that I'm doing the advice, I do hourly because that's the fairest way to charge a client for that advice.
Okay, I understand. Rick, you interviewed John Bogle shortly before his passing, and I wanted to ask you about what personal lesson from him most impacted you as a person, as an investor, and also your career.
So Jack was way beyond his years when he was conceptualizing what the business should be. And he was talking about you cannot serve 2 masters. Most mutual fund companies have owners of the mutual fund company, and they want to make as much money as they can off of the clients in those funds. So the clients in the funds are trying to make money off of the investments, the markets that are in the mutual fund. They have to pay a fee for that. And the managers over here, they want the fee to be the biggest fee it can be. So there was this real conflict of interest in the mutual fund industry and in the investment industry. And I described the same thing in the advisor industry. Jack didn't believe that. He said we should be charging fair fees for managing mutual funds, which is why Vanguard was started as a nonprofit or mutual benefit organization. And they don't make a profit per se. They just keep lowering their fees as they make more money. And in fact, recently they just lowered the fees again on over 100 different funds that they manage. So that's a good idea, way ahead of his time. The other thing that Jack realized was the majesty of simplicity. You don't need a lot of stuff in your portfolio to do well. You just need to get your fair share of market returns. And he was saying this over and over and over again. Now, the industry doesn't want to hear this, of course, because they can't make any money that way. But he's true. And he was right about that. And the more I'm alive and the more I do this, and I've been doing it for more than 35 years now, it's absolutely clear to me that Jack had it right. Simplicity is a virtue. You keep your portfolio simple, keep it tax efficient, keep it low cost. You will do better than all the other stuff that's going on out there.
By the way, once you wrote that you can measure Bogle's quality by the size of your bank account. I really like these words. So now we can understand how his work democratized wealth building for everyday investors. I wanted to ask you if you could maybe leave our listeners with one principle. I know it's hard, just one principle to guide their investing journey. What would it be? Just one principle.
Well, I'm going to go back to the 3 that you mentioned. So the 3 things that make you a successful investor is you have to have a philosophy of how you're going to approach the markets. Are you going to try to outperform the markets? Are you going to try to pick managers that are going to outperform the market? Are you going to do managed futures because you think that it's going to somehow help your portfolio? Or are you going to keep it simple in a few good index funds? So if you are under the Boglehead's philosophy. That's what your philosophy is. The next thing you need to do is strategy. Now you need to develop, how are you going to do this? You're working, you have a 401k, you have certain investment options in the 401k that you have to pick from. Which ones do you pick? How do you make it work in your portfolio? What's your asset allocation? Whether you should have taxable bonds, municipal bonds. This is strategy. So you develop a strategy around the philosophy. And the last thing, as we talked about again, is having the discipline to stay the course. Those three things will make you a successful investor.
Right. Great. Thank you very much, Rick, for that. By the way, I also recall the words you said that the path of an investor is like going through darkness, then to enlightenment,
Right.
then complexity, and finally finding this nirvana of simplicity. So I really like this description because it's so powerful. But before we wrap, where can listeners follow your work or connect with you, Rick?
Well, they can follow me on rickferri.com. I try to make it simple, right? So I just use my name. rickferri.com is where I post. I will be posting more later on, in the next few years. But you can find my books there, my podcasts, some articles that I wrote. But eventually, I'm going to get back to writing more. And if they want to contact me, there's a contact page there that they could send an email.
Thank you very much, Rick. And to our audience, also, if you are inspired to build smarter portfolios, visit etfatlas.com. And until next time, invest wisely and remember, simplicity often outshines complexity. Thank you, Rick.
Thank you for having me.
Thank you.